Aswath Damodaran, professor at NYU Stern School of Business. He's called as the go-to man who understands valuations completely thread and bare. He really understands that how stock market should ideally value a company, an asset or a stock. Professor Damodaran, an absolute pleasure to have you back on ET Now. Thank you for joining us. Now, Professor, I managed to read your latest post on how you've characterized the recent bout of volatility. So what is your sense? First, we saw a big fall. Everyone said that, run to the hills and, sky would fall apart. And now after that, we've seen a strong reversal as US markets have made an exceptionally strong comeback.
You know how when you're on a long flight, the pilot comes on and says, there's going to be turbulence ahead, put your seatbelts on. We're in that phase of the flight, which is there's turbulence ahead, there's going to be ups and downs, and in a sense, when turbulence comes on, you're not going to crash in the ocean. Once in a while you might, but most of the time you make it safe. So I think that's the way you have to think about it. This is turbulence in markets. You got to live with turbulence, and this is why you get a risk premium. Sometimes we forget what the definition of risk is until you have a period like this one, where you get a reminder, this is what risk is. This is why you should be demanding a premium when you invest in something risky.
So, Professor, there are three factors why markets they always correct. Panic attack, which is short term in nature, risk adjustment, which could be linked to interest rates, or outright bloodbath or beginning of a bear market, which could be linked to an event or a trigger. So, if you really have to characterize the current leg of volatility and market fall in these three brackets, how would you like to characterize it?
The three reasons are not mutually exclusive. Almost every sell-off has elements of all three. The question is, which is the dominant one? This particular sell-off was triggered by a news story about inflation increasing in the US. That inflation increase caught markets by surprise. And when inflation goes up historically, risk premiums have gone up. So the increase in inflation pushed into a higher risk premium. And once you see sell-offs, then panic sets in. So all three factors were in play, especially in that first week. The panic part of the attack has gone away. So what you're seeing now is an attempt to try to get into some steady state. If there's going to be higher inflation, that's going to mean higher interest rates, and higher interest rates will have to be adjusted for in value. So that's why I said there's turbulence ahead. Markets are going to have to adjust to the fact that they've had 10 years of abnormally low interest rates. That period, I think, is coming to an end, at least in the US. I think that a healthy economy in the US will mean 3.5%, maybe even 4% T-bond rates. And it'll take markets a little while to adjust to that new reality. So I think this is one of those sell-offs where there was a panic component in the first week, but that panic component, even if it goes away, doesn't mean stock prices are going to bounce back to where they were before the panic, because there's some real issues that we have to deal with in markets.
Professor, the current problem in the world about inflation, is this a good problem to have? Because frankly, 2 years ago, we were discussing the whole problem of negative interest rates. Now markets are scared because growth is making a comeback. So do you think the fact that inflation is coming back, it is not a bad problem but a good problem to have?
Inflation is back, but inflation is 2%. 2% is not astronomically high inflation. It's actually inflation that's consistent with a healthy economy. So I think that when we talk about inflation, we have to realize that part of the reason of inflation is the US economy is finally delivering wage increases. For a decade, we've talked about how low-level labor is not getting any kind of an increase, any benefit from globalization. Now that they're getting the wage increases, of course it's going to show up as inflation. To me, inflation is a sign of a healthier economy, and that, in a sense, is something we all want. So that's why when people say inflation is a bad thing, I say be careful what you wish for, because you could have Switzerland or Japan as your alternative. And think of what's happened in Japan over the last 20 years with deflation. You've had an economy that's in shambles, that essentially cannot grow. So I think inflation is more a sign of health. Right now, at least. It could get worse if it gets to be 5 or 6%. But at 2%, it's more a sign of health than a sign of sickness.
So, Professor Damodaran, what do you mind could be that tipping point for the 10-year 10-year treasury paper beyond which you would say markets they genuinely need to worry? Is that 4%, is that 3.5%, or is that anything beyond 5%?
Rates have never been the driver of profitability. I mean, rates affect profitability only by affecting the economy. So if rates going up slows the economy down, then profit. So by itself, higher interest rates can't hurt you as a company because, as you said, if you're in a healthy economy, you're going to pass those rates on to your customers. So by itself, higher rates don't bother me. It's if the higher rates start slowing the economy down that you have to think about the consequences for earnings growth. And we're not even close to that tipping point yet.
Now, Professor Damodaran, the entry price of any asset also is a guiding factor to what will happen to projected returns. Given that we are in a 6-7 year old bull market in US equities, the average valuations are or the valuations for S&P are trading way above their historic high. Do you think somewhere we could be going through this patch of consolidation where growth will come back but markets will not get very excited about it because markets have already moved in anticipation of strong growth?
You know what I know my strengths and I know my weaknesses, and one of my biggest weaknesses is I'm an awful market timer. I'm horrible at it. So if I listen to my gut or my instinct say, hey, this is now the right time to buy stocks, or this is the right time, I've discovered historically that I'm more likely to be wrong than right. And I have to remember that because I'm tempted, like everybody else, to decide when to enter and when to exit. So I'm going to give the same advice that I give all my kids. I said, don't try to be market timers. It's a hopeless task. You're going to end up over time paying for it. Instead, enter the market if you have money to invest, exit the market if you need the cash. Let the market take care of itself. Your investment philosophy, if it does not include market timing, should also mean that you're not trying to find entry and exit points because that's going to slow you down. I know people who've been sitting on cash for 10 years waiting for the right entry point on stocks. That is the consequence of trying to time entry is you wait for the right time, the right time might never come. So if you have a lot of money to invest, just go ahead and invest it. I'm a stock picker. So here's what I'm going to continue to do. I'm going to value companies, and if I find something to be cheap, I'm going to buy that stock and not look at whether the market is cheap or expensive, because as I said, that's not my strength. That's not to suggest that you shouldn't try to time markets. If you're good at market timings, by all means, go out and time markets, decide when to enter or exit, but make sure you're being honest with yourself.
Now, Professor, for the longest time, you've been advocatory of calculating equity risk premium. And on your website and again on your blog, you very neatly maintain this on a daily basis. So what is your take on the current risk premium for stocks? And is the current equity rate indicating that one should be buying US stocks or US equities?
They're pretty close to average. In fact, I computed the premium for March last night, and it's 4.96%, roughly 5% in the US right now. The historical average for that number is about 4.5%. So you're actually getting a higher premium than you'd have had historically. So to me, that's not a red flag. In contrast, in 1999, at the peak of the dot-com boom, the equity risk premium was 2%. The average then was about 5%. 2% is much lower than 5%. So if you'd asked me at the end of 99, am I worried? I'd have said yes. Today, the equity risk premium seems to be a reasonable number, at least relative to history.
But do you think Indian stock markets and US stock markets, they are, the cycles are different because for India, the economic recovery has not kicked in. For US economy, the economic recovery has kicked in as percentage of total profit. Profit as percentage of GDP in India is at historic low, but for in US economy, profit as percentage of GDP is reading a record high. Again, the important indicator, Professor Damodaran, which Buffett often uses, which is that market cap to GDP, and on that account, India is cheap, but US markets are expensive.
I think that there is a global component to markets still. So if you look at the first week of February, pretty much every market in the world was affected. So during crisis periods, the correlation across markets tends to go up. When the crisis recedes, local factors kick in. And India, perhaps more than any other large emerging market, has a lot of local factors kicking in. You've got banking reforms. You got an economy that is filled with change, right? From demonetization to the opening up of sectors to global competition to banking being held to order. You're seeing changes in India that are going to affect the market. You also have a sense that this might be the start of an Indian decade, just like the last 20 years were China's 20 years. Maybe this is the start of something big. Of course, these things can very quickly change, right? Today's optimist can become tomorrow's pessimist. But I think you're right. The Indian market in particular has so many local factors driving it that the correlation is probably lower than it's been historically simply for those reasons.
What do you make of the plight of the Indian banking sector? PSU banks are in a strong disarray. There is a structural and a cultural problem. And the way these banks are getting recapitalized again and again by government of India, just reminds me of a school kid who's got bad habits and is actually getting rewarded rather than get punished for that.
Yeah, the cleaning up of banks is going to be the major issue that India has to face in the near term. Because let's face it, I mean, anybody who has any degree of familiarity with the Indian banking system knows how much of the big bank loan system was based on crony lending, basically, where banks did not do their due diligence, but because a family group or a business person with a reputation came to them, they were willing to lend on very thin credit. And now many of those mistakes are going to be brought to the surface. And it'll be interesting to see how big a problem it is, because I don't think we even know how big it is until we start digging. I think you've seen only the start of the process, not the end of the process, and the cleaning up is going to be painful. And as with regular companies, you're going to start to have to separate good banks from bad banks. And perhaps some of those bad banks will have to be folded into the good banks. But I think that it's going to be painful. It's never, cleaning up banking messes is never clean. Is never going to, be without consequences. And you're going to see that cleaning up have some consequences, not just for the banks, but for some of these lenders who are now going to be called to account for themselves by regulators, and that's going to that's going to create some pain for them as well.
So, Professor, for a minute, let's assume that the PSU banking system in India does not get fixed. Do you think that could have an impact on the aggregate credit and liquidity in the system? Because the basic purpose of PSU banks is also to lend growth capital and risk capital to companies and to entrepreneurs. And if PSU banks will have a weak balance sheet, and if they would be careful in now lending, could that have an impact on the aggregate lending cycle per se for India?
Absolutely. And I think that's why you need I'm a fan of creating corporate bond markets that are healthy markets. Because to me, if your only source of loans is a bank, any banking crisis is going to become an economic crisis. So I think it's time that at least the larger Indian companies started looking past banks and started looking at the corporate bond market as a primary way of raising debt for companies. It's a much healthier system because you don't have the kind of crony banking when you have a bond market, and that I think is that I think will make companies and banks healthier.
Now, Professor, in one of your recent posts, I think about 6 months ago, you had indicated concerns about the way Tata Group of companies were being run. But for the first time, there is a non-Parsi chairman. Chandra understands the importance of capital allocation. He in a sense is an IT guy who knows how to run a tight and a very efficient ship. So do you think capital allocation, which has been a challenge for the Tata Group per se, could change now significantly better?
I've been very impressed. I've been very impressed with Chandra because I think that in a sense, he comes from a position of strength. When you're the person who's built up the company that accounts for 60 to 65% of the overall value of the group, you're going to carry a lot of weight. And I think because of that, I think people have been much more willing, and the family has been much more willing to give him the power to go out and make changes. So I think it's been, and that's why I said there's hope. I mean, I've never been one who says family groups are wrong. You shouldn't have family, because family group companies have their own advantages. There's good in them. And I think what I think that the last couple of years of the Tata Group illustrate is there's hope in every family group if they can get good people up in front and let them make the big decisions rather than make decisions that reflect history or whatever the family group might have been attached to.
Now, Professor, you've always said that, look at Indian companies which have a very strong global presence but are masters or leaders of the domestic market. So, which are some of the Indian companies where you think that there is going to be a strong, where there's a strong growth potential and they are likely to move independently of what is happening in the world? A classic case last time when we met was Maruti. So anything apart from Maruti which has come on your radar?
I think a lot of Indian companies are a way have a benefit, which is you have a growing economy with a huge population, which India does. That gives you wind behind your sails, right? So even if you're a company or even a mature company, an automobile company, for instance, in the US, is starting off with the presumption it's a mature company because unless you're a Tesla, you're really selling into a mature market. You're not going to grow 10% a year. Indian companies have the benefit of a large population and a growing economy, and that gives them an advantage in terms of growth. So, to the extent that Indian companies can exploit the growth in the economy, kind of hang in there, even mature Indian companies, companies like Britannia, right, a food company, you're saying, why do food company have growth? Companies that are able to grow with the economy are going to be able to show high growth in revenues and earnings simply because they're benefiting from the growth of the economy. I think, in a sense, in this pull towards globalization, Indian companies have sometimes forgotten that their biggest and most lucrative market is at home. I mean, I like to use the example of Indian automobile companies, where Maruti, by focusing on its domestic strengths, has done what Alibaba did in China, which is, hey, we know the local market better than those outsiders do. We're going to build cars that are built for the local market. So those Indian companies that take care of their Indian consumers, and I've discovered that many Indian companies seem to care more about their foreign consumers than they do about their domestic consumers. If you can take care of your domestic consumers, you can deliver the goods and services that they want, and you can tailor them to their particular needs. I think Indian companies have that growth potential, that growth advantage that many companies outside India do not have.
All right, and Professor, closing comments. You've always said that there is no concept of fountain of youth in any corporation's life cycle, and you've said in the past that Indian IT companies are now like old US manufacturing companies where the prime time is behind them. But suddenly, Professor, the tide is changing again. Digitization now accounts for nearly 25 to 30% of the total net revenue for Indian IT companies. So do you think Indian IT companies can reboot themselves, or it would be very difficult for them to come back when global technology platforms and delivery models are changing?
I was saying that what makes you successful often ends up putting handcuffs on you. And what made Indian companies, these Indian IT companies, successful in the 90s and the last decade was the fact that their costs were lower than their foreign competition. So all their technological skill sets were driven towards lowering costs so that they could compete in this global marketplace. And they succeeded. The only problem is that if your advantage is a cost advantage, at some point in time, as you get more prosperous, there will be other countries with even lower costs. So whether it's Philippines or Nigeria, where you might have English-speaking, software engineers who will accept a lower pay than Indian engineers do, at some point in time, your cost advantages will go away. If I were advising Indian IT companies, I would say, look, you have this incredibly skilled workforce, but you got to change the orientation away from just cost cutting and having the lowest cost to delivering more innovative products. But that requires a mindset change. It's not going to happen overnight. But I think Indian IT companies, if they want to benefit from the next wave, have to focus more on innovation and less on cost-saving technological changes. And I think it'll happen, at least at some of these companies, but it's going to be a hard climb.
Professor, so how would you really characterize the current market cap which some of the FANG stocks are commanding? Apple is nearing $1 trillion, Google or Alphabet almost there, and Amazon also is catching up. Do you think there is a bubble in making in some of these so-called haloed US tech companies?
You know what? These companies are being priced for global domination, right? I mean, if you look at Amazon's market cap, it's almost like people are expecting Amazon to keep growing, to be able to improve its profitability and deliver value. And guess what? These companies are actually delivering on global domination. In fact, my colleague at Stern, Scott Galloway, has written this book called The Four, and if you get a chance, you should take a look at it about the four big tech companies: Alphabet, Facebook, Apple, and when you look at these companies and Amazon, when you look at these companies, here's the common feature they have. Normally, when companies get bigger, it gets more difficult to grow as you get bigger. These companies, as they get bigger, are finding it easier to grow as they get bigger, and that's going to create some economic issues for us down the road, which is at some point in time, if it's all not already happened, these companies are going to push their competitors off the table. Amazon does it in almost every business it's in. Alphabet and Facebook have destroyed the rest of the advertising business because they're such big players in the game. So I think at some point in time, we'll have to confront the fact that these companies have become so big that they, in a sense, are governments, they answer to nobody. They're too big to answer to any particular government. But I think they're priced for global domination. Would I invest at the prices they're trading at? Well, the only one of the four that I think is priced at a level that I could invest in it is Apple. The others, to me, are priced on the expectation that they can push on to global domination without any pushback. And already you're starting to see the signs of a pushback, politically and economically, against some of these companies, first in the EU, but even in the US. And that pushback is going to be interesting in terms of the consequences it has for growth and profitability.
Closing comments really. My next question to you is on Bitcoin and blockchain. Do you think blockchain as a technology is here to stay, but Bitcoin as a currency will lose its relevance? Because ultimately, Professor, the objective of a currency is to have a transaction value, and frankly, at a time Bitcoin is lacking that basic edge of transaction, how does one really judge the true value or the true intrinsic value of Bitcoin?
I'm glad you separated the questions, because in a sense, I think we make a mistake of combining blockchain with Bitcoin with other cryptocurrencies and dealing with them all in a lump. But they're really very different. Blockchain is a technology. Blockchain does not require cryptocurrencies. You can have a blockchain that's based on fiat currencies. So blockchain is here to stay because it is an innovation that I think will reduce transactions costs and make it easier to do some transactions. So especially in financial services, blockchain is going to revolutionize parts of banking and financial services. So blockchain is here to stay, no debate. Bitcoin and other cryptocurrencies, it's a different debate because I firmly believe that in the long term, we're going to have a digital currency. We're going to have a digital currency that's globally accepted because it's going to be convenient. It's going to tie in much more closely to the blockchain technology. The question, though, is whether any of the existing cryptocurrencies is going to be that final digital currency. On that, the jury is out. Because if you look at the existing cryptocurrencies, especially Bitcoin, it is not very well designed to be a long-term good digital currency. And for a couple of reasons. One is the designers of Bitcoin were a little paranoid and a little geeky, which is they designed a currency for which was going to be the gold for the new millennials. And it's done that job really well. But gold has never been a great currency because you can't carry gold around and pay for your coffee. And Bitcoin has to make up its mind. Does it want to be a speculative investment or does it want to be a currency? Because if it wants to be a currency, what needs to happen is it has to settle down. You can't have a currency where the value of the currency, the price of the currency goes up 50% by midday and drops by 30% by the end of the day. No merchant is going to accept that currency. So my test for Bitcoin is whether the focus shifts away from how good or bad it is as a speculative investment to how good or bad it is as a transaction currency. And it's not happening yet. And when that happens, I think that'll be a healthy sign.
Professor, what a delight to have you on ET Now, and I certainly hope to see much more of you going forward. And thank you for brilliantly articulating and breaking the entire market setup for us.